Hello students, today we are coming with the last and final part of our first chapter, Introduction to Accounting, and we will be covering the remaining basic terms in this lecture. So let's start. In the previous video, the last terms which we have discussed is receipts and expenditure. Now let's move to the next term, that is trade receivables. So by the term trade receivable, it is basically sum of debtors and bills receivables. Collectively, the total amount of debtors plus the total amount of bills receivables are termed collectively as trade receivables. Now the point comes is, what is the meaning of debtor and bill receivable? Trade receivable are merely the sum of these two things. So we have to understand the meaning of debtor and bill receivable. So let's start with the meaning of debtor. See, it is not possible in a business to conduct all transactions on cash basis. It is a basic assumption that more than half of business transaction occurs on credit basis, which means exchange of goods are done right now, but the payment will be received in a near future date. This is how a trade cycle or a business cycle operates, majorly on credit basis. So the transaction happens both on cash basis and on credit basis as well. Debtors are an outcome, are a result of credit transaction itself. So how does the debtor arise? See, if a business has sold goods to the customers, but the customers have not paid the amount against those goods at this particular point of time, but they promise to pay. I urge you to pay attention on the words which I am using. The customers have promised to pay that sum of money after a particular period of time. Say for an example, after 20 days, as we have illustrated in our example. So the business has sold the goods to the customers, but the customers have not yet paid the requisite sum of money against those goods. But what they have done, what the customers have done, they have promised the business that we will pay you the money on a later date. Say for an example, after 20 days. So on the basis of this promise, the business is allowing a credit period to the customers. So here the customers will be known as debtors of the business. This term is pronunciated as debtors. B remains silent. The pronunciation will be debtors. So by far, the meaning of debtors is the person who owes certain sum of money to the business. But obviously, business won't be selling goods on credit to each and every newcomer or new customer in the market. Business would be selling goods on credit to only those customers who are known to business, who are regular customers of the business, or those customers who have goodwill in the market. We have already discussed in our previous video the meaning of goodwill. It falls under the category of intangible asset. So business would be selling goods on credit to those customers who have goodwill in the market, who are old customers, who are regular customers, who are personally known to the business. Only then business can give the goods on a good faith to the customers. So the term debtor is used for those persons to whom goods have been sold or services have been rendered on credit. Debtors are basically example of current assets. We have already discussed the meaning of current asset. Means what? Those assets which gets converted into cash within a period of 12 months. Let's move on to the meaning of bills receivables. See, bills receivables are basically an outcome of the transaction which we have already discussed. That is, goods sold on credit. While selling goods on credit, what we have created? Some debtors for us. I was specifically mentioning that you should pay focus on the words which I am using. We have used the word promise earlier. The customers have promised the businessman to pay the certain sum of money after a particular period of time. Now comes the role of bill receivable, where it is not possible that all the customers will be known to the business or the businessman. But in order to expand business, we have to get introduced to new customers. We have to build business relations. We have to develop our business with new customers as well. So how come we will be allowing them a credit period without knowing them? They were not our regular customers. They were not our old customers. We don't know about any of their business operations. We are not familiar with them. Then how come we trust them? How come we have a faith on them that they will be paying us requisite sum of money after that period of credit, after that period of time which the business is allowing them? Precisely, if I am unknown to someone, that person won't be giving me anything on credit without knowing anyone. Nobody will be going to give anything on credit. Here comes the roles of bill receivable. So in our previous example, we have discussed this particular thing, that the business has sold goods on credit to the customers, and the customers promised to pay. Customers promised to pay that sum of money after 20 days. So if the customers were known, business will not be much concerned about executing a legal document to bind their customers legally to pay the requisite sum after that period of time. But if the customers are new one, but if the customers are unknown to the business, what option does a business has? So here comes the role of bill receivable. A legal document, a legal paper will be executed between business and the customers, that is debtors. A legal paper will be executed between business and the customers. That legal paper will be binding on the debtors, that they are bound to pay the requisite sum of money after expiry of that specified period of time. If they failed to do so, business can execute any legal action against the debtors. See, in our previous discussion where we were discussing about debtors, debtors promised to pay certain sum of money after expiry of a specified period of time. They merely promised to pay. There was no legal document executed between customers and the business. So what if customers deny to pay after 20 days? Business will left with no other option. Business cannot execute a legal proceeding against customer, because merely an oral communication between these two parties on good faith does not have a legal existence. But in second case, where we are discussing about bills receivable, here business will be executing a legal paper over customers. Now the customers cannot deny their liabilities to pay requisite sum of money to the business after expiry of that period. And if they failed to do so, business will have all the rights to execute any legal proceeding against the debtors. So BR is basically what? In short, we write BR as B/R both in capital letters. They are legal binding instrument which will make sure that your debtors must pay you the requisite amount. If debtor is not trustworthy, business may draw a legal document, a bill over the customers to bind them to pay the sum after a certain period of time. Bills receivables also falls under the category of current assets, same as in the case of debtors. Both debtors and bill receivable are example of current asset. I suppose you might have heard about or have seen a stamp paper, which is a legal document. In the same manner, bills receivable is also a legal paper, a legal document, which will be executed by the businessman over its debtor to secure its credit sales. So the business will execute a legal paper over debtor. Debtors will have to sign that legal paper and hand it over back to the business. That is the meaning of bill receivable. So the sum total of debtors and bills receivables are collectively known as trade payables. Just opposite to trade receivables, our next term is trade payables. As bills receivables are collective sum of debtor and bills receivable, bills payables and creditors are collectively known as trade payables. Trade payables is sum total of the creditors and bills payables. Creditors are just opposite to debtors and bills payables are just opposite to bills receivables. While discussing debtor and BR, we took the example of credit sales. Now, while discussing creditors and bills payables, we will be taking the example of credit purchases. That is the only difference of story. So, if the business had bought goods or raw material from the seller on credit and the business is not making payment right now but availing a credit period, what the business is saying to the seller, that we will pay you the money later after 30 days approx. So if the seller or creditor is known to us, he would be allowing us a credit period without executing any legal document over us. So merely a credit sale from seller and a credit purchase for us will result in a relation of creditor. So creditor basically are those persons to whom we owe certain sum of money. The term creditor is used for those persons from whom business has purchased anything on credit. They falls under the category of current liability. That is what we are supposed to pay them back within a period of 12 months. We have already discussed the meaning of current liability, those liabilities which gets discharged within a period of 12 months. So if our business has purchased something on credit from any seller, that seller becomes creditor for our business. But if the seller is unknown or unrelated to the business, that is, this is for the first time we are dealing with this seller or we are purchasing goods from the seller, then seller might be of opinion that we means the business, refuse to pay the requisite sum to the seller after expiry of that specified period of time. Then what seller is going to do? Seller is going to execute a legal paper over us. See, in the situation of bills receivables, we were executing BR over debtor. Now the creditor is executing a legal paper over us. That is the basic difference between these two things. So what is the meaning of bills payable? In short, we write bills payable as B/P. They are legal binding instruments which can be drawn upon business from its creditors if creditors have a doubt regarding business trustworthiness of paying back the due amount. So if the seller of creditor is of opinion that we might refuse to pay him back the requisite sum of money, then what seller can do? He can execute a legal paper, a binding paper over us. So it will be a legally binding instrument, and now the business cannot deny to discharge its liabilities after that aforementioned period of time. If the business do so, then he should get ready to face the legal complications. That is the meaning of creditors and bill payables, and collectively the sum of creditors and bill payables are known as trade payables. Let's hop on to the next term, that is discount and its type. Generally, saving of any sum of money while buying or selling. Difference of amount, that is basically what discount means. If I'm going to buy a packet of bread which costs rupees 20 and on that particular day I got to buy that packet of bread for rupees 15, that difference of amount rupees 5 is basically treated as discount. So any sort of money which is claimed in form of bargaining or which is given by seller himself is discount. Discount is categorized in two categories. It could be cash discount or could be trade discount. Let us understand the meaning of these two discount by quoting an example which we usually does in our real life. I went to buy some garments. I went to buy a jeans. That jeans cost rupees 2000. After shortlisting, after finalizing that jeans, I started bargaining from the seller that I would be paying only 1800 bucks for that jeans. After minutes of discussion, the seller agrees to sell that jeans for rupees 1800. So this particular discount of rupees 200, which is claimed by buyer after bargaining it with seller, is cash discount. So the basic thing which we need to understand here is cash discount is never offered by the seller himself. It would not work like this. You went to a shop and seller says that this jeans cost rupees 2000 bucks, but I would be giving it to you for rupees 1800. Seller doesn't gives discount at their own right in front of a customer. Customers bargains for a product and claims that discount. That is an example of cash discount. Whereas for understanding trade discount, in general, we usually observe few advertisements and hoardings outside showrooms, flat 20% off, buy one get one free, off season sale, flat 30% off. These are the example of trade discounts. Trade discount is not upfront claimed by the buyer, but it is something which is given by seller themselves. We didn't go to the seller and tell them to display hoardings of buy one get one, to display hoardings of 30% off, 40% off. Seller does themselves. Seller takes the decision by themselves to give these kind of discounts. These are example of trade discounts. So basically, what is the difference between cash discount and trade discount? First thing is, cash discount is claimed by buyer, whereas trade discount is given by seller itself. The prima facie intention behind discount. Cash discount is given by the seller in order to convert its goods promptly into cash. What is the basic intention of seller? To sell its goods and gets it converted into cash as quickly as possible. Whereas the basic intention behind giving trade discount is to boost up sales. It happens if we observe the hoardings of buy one get one free, flat 20% off. It is common human nature that we tend to purchase more of those goods irrespective of the thing whether we actually needs those goods or not. So trade discounts are generally given to boost up the sales, to increase the sales volume, or to clear the stock. So discount is basically a rebate given by seller to buyer. Discount may be classified as cash discount and trade discount. Cash discount is generally provided to receive prompt cash payment. Cash discount is always recorded in book of accounts. For example, a seller gives 5% discount if the amount will be paid within a week. Say for an example, if a seller has sold some goods on credit, the buyer says, I will be paying you the money after 20 days. So the seller was of opinion that 20 days will be a longer period of time. What seller said that I would be giving you 5% extra discount if you pay me within a period of 7 days. So the basic intention behind giving cash discount is to get prompt cash out of the sales. Whereas trade discount is type of discount that is generally given to boost up the sales, and trade discount is never recorded in book of accounts. See, the cash discount is always recorded in the book of accounts, whereas trade discount is never recorded in the book of accounts. For example, 20% off on the list price of goods as written on many packaged goods. Let's move to the next term, that is voucher. So vouchers are basically prima facie evidence of any transaction. We have discussed the meaning of transaction, any sort of exchange between two or more persons which can be measured in terms of money. So on the basis of those transactions, accounting will be done further. But while transacting, while doing any sort of transaction, some vouchers are prepared. Vouchers are basically those piece of papers with which we can prove that a transaction had happened. So any piece of paper, any document which can evident, which can work as a proof of any transaction is termed as voucher. So any document which provides authorization, authentication for business transaction are primarily recorded in business records as voucher. For example, merely a check, which I suppose you might have seen, a simple check of any bank, bills receivable, which we have just discussed, bills payable, any cash memo which we get while paying cash at the shop or departmental store are basically example of vouchers. So this is the last topic of basic accounting terms. Let's quickly go through these terms. Bad debts. Bad debts basically means what? If my debtors deny to pay the requisite sum of money after expiry of a specified period of time, then those debtors will be termed as bad debts. What does bad debt recovered means? If any previous bad debt is recovered, which means a debtor which earlier refused to pay me my money back has now agreed to pay it, has actually paid me that bad debt, will be known as bad debt recovered. So if someone pays us back the amount which was earlier written off as bad debt, it will be known as bad debt recovered. The meaning of insolvent: a person or an organization who is incapacitated to pay off its liabilities. Any person who cannot pay off its liabilities in requisite period of time is known as insolvent. Next term is bankrupt. See, often insolvent and bankrupt are used interchangeably, but that is not the correct thing. Insolvency is something that a person is incapable of paying it anyhow. He doesn't have any resource to discharge its liabilities, whereas bankrupt means that the person or the enterprise does not have ample amount of money in its bank account only, but in personally he has ample amount of money. Bankrupt merely means shortage of money, or you don't have money in your bank account. Your checks are getting bounced. That is a situation of bankruptcy. Whereas insolvency is something which arises after the stage of bankruptcy. Insolvency means you are completely wiped off. You do not have anything to discharge your liabilities. Whereas in bankruptcy, it means you do not have money in your bank account only to discharge your liabilities. Next term is turnover. So the total sales made throughout the year, the total volume of sales or total value of goods sold throughout the year is basically turnover of a business. Livestock. So there are some business in which there's a need of animals, cattle, etc. So those animals will be termed as livestock in accountancy. Entity. Entity basically means any person who possesses legal distinct identity from others. Precisely, I do have my distinct entity. You students have your distinct entity. An organization has its distinct entity. So anyone who possesses a legal distinct identity from others is basically entity. So students, these were the basic accounting terms which you were supposed to understand before going further with this subject. So I suppose you will be getting familiar with these terms after watching these videos. Go through these videos again and again. Make yourself comfortable with these topics. Only then you will be able to understand upcoming topics. So we will be finishing off this video right here and hope you will stay tuned for further updates. Thanks for watching.